Hi, I'm Shiloh Bates, and welcome to the CLO Investor podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players. Today, I'm speaking with Serhan Secman, Global Head of CLOs at Napier Park, which is part of First Eagle Investment Company. We talk about learning the CLO investing business, inefficiencies in the market, and the three factors that negatively affected CLO equity in 2025. That's higher defaults, declining loan spreads, and CLO equity generally trading cheap. This discussion may include hypothetical market scenarios and modeling assumptions for educational purposes only and should not be interpreted as expected performance. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And if you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Serhan Secman. Serhan, thanks so much for coming on the podcast.
Thank you, Shiloh. It's great to be here.
So why don't we start off with your background, Serhan, and how you ended up in the CLO business?
I'm an engineer by background. I went to an engineering school back in Turkey and went to master's in Texas and started working within the industry in Texas. And I love the engineering, and engineering is a way of thinking rather than a collection of knowledge. It's just a collection of skill sets that you apply numerical and analytical thinking. And then after a few years in engineering, I thought that I could use my skill set a little bit better in finance. And the prompt to that was that my wife, who graduated again from Texas A&M, had her PhD in math, started working for a hedge fund. And I found what she's doing a lot more interesting than I'm doing. So I decided to go to business school. I ended up being selected as a great school. So I was lucky to go into Wharton, and that was the beginning of my finance journey. I recruited for sales and trading. I ended up going to Lehman Brothers, a place where I really enjoyed being part of for 2 short years, but I call them as dog years. Every year was worth the 7 years of experience. It was quite intense, but in the end, I think I learned a lot. And roughly about 2 weeks before Lehman went under, August of 2008, I was hired with Citi Alternative Investments, as a CLO or a CDO. At the time, we used to call them as CDOs, CDO trader slash investor. And that was the beginning of my investor career. At Lehman Brothers, I was a trader, but in Citi Alternative Investments, I switched into the buy side. My career at Citi Alternative Investments evolved from being a trader, being a PM, into more on the business side. Now I oversee the global CLO business for Napier Park, both on BSL and middle market.
So on your platform, have you rebranded it as First Eagle, or you're keeping the Napier Park name?
We're keeping the Napier Park name. First Eagle is a very strong brand in the industry, but focused on a different corner than Napier Park operates in. Napier Park, over the years, had built a reputation that is very valuable, and we're keeping that Napier Park reputation, and therefore the brand is intact.
And do you spend most of your time then investing in CLOs managed by other firms, or do you spend a lot of time focused on the CLOs that Napier Park manages?
Currently, I spend more on the business side of it, and I have teams that is focused on investing in other manager CLOs, and I have teams that is focused on managing our CLOs. I tend to play a role of more on the business side and trying to make sure that all the gears turn in the direction and the right efficiency as they do turn. But my background, my day job used to be mostly on the investing side, investing in other managers' tranches. And mostly we used to focus on the lower end of the capital structure, mostly equity, single B, double B, sometimes triple B.
I saw a stat the other day that there was 150 different CLO managers that issued last year. Obviously, Napier Park is both a large and well-regarded manager, but how do you see your platform as differentiated from all the other guys out there?
So 150 managers, that's quite a bit.
Too many.
Too many. You're right. You compare it to 1.0 era, surprisingly, market was much smaller, but we had more managers at that time. I remember counting it north of 180 in 2007. There has been a consolidation cycle that we went through, most pronounced in 2010. But later on, it became a norm that the market constantly brings in newcomers to the market. New managers are born, and some old managers are phased out, and they either phase out naturally or some of them goes through a M&A process and they become part of a larger program. When you look at the landscape, there are several ways that the managers can differentiate themselves. It could be on where you position yourself on the risk spectrum. It could be on how active you manage your portfolios. It could be on how do you source your loans, on which corner of that loan market that you are more keen on. And if I look at from those perspectives, you could do a cluster analysis and see what managers fall under what category or what cluster. But I would put Napier Park into a cluster where there's a lot of conservative portfolio construction. So the credit wise, we're more on the conservative side and we are more on the diverse end of that spectrum. There are some managers that likes taking concentrated bets and there are some managers that lean more on the diverse side. So that's the second attribute that would identify Napier Park. And maybe the last one is that we are very active in the way that we manage our portfolios. And combination of these three attributes is the thing that I would say the differentiating factor for Napier Park as the style that exists among these 150 managers.
So if a new associate joins you guys from business school and they're going to be investing in third-party CLOs, what's some words of wisdom you'd give them on day one?
Data analysis. That would be the first thing that I would ask him or her to focus on getting to data regarding the CLO managers, CLO deals, and jump on it and try to find conclusions. We're very lucky as CLO investors. We have access to tons of information, tons of data, and this asset class couldn't be more transparent. And there's so much information about what does managers do, how do they construct their portfolios, what names are in their portfolios, what do they buy, at what price, what do they sell, at what price, what happened to the loans after they sold. All of those are very important information that somebody who is fresh into this field can just jump and swim in this data and come up with hypotheses on what a good manager should be, and then see whether that has been tested with this data and come up with which managers are worthy in investing in what part of the capital structure. And that's something that I found as an engineer, maybe tying back to my background. I find it fascinating because I'm an engineer by trade, and once an engineer, always an engineer. I always look at things in a very analytical way and try to take very complex question like which manager should we invest in and try to divide into more manageable questions, simpler questions, and then find answer to those smaller questions or simpler questions by analyzing data and then combine all of these together into a thesis. So that's the thing that I would push anybody who is coming into this industry to make themselves familiar with data analysis, data management, because it gives so much information about the managers, gives so much information about the deal performance. But I would like to hear your answer to the same question because I know that you're a very astute investor. You do a lot of these things we do. I'm very curious, what's your answer?
Well, I'll give you two different answers. So one is that I went to University of Chicago for grad school, and they bake into you this or beat into you this idea that the market's efficient. And I wouldn't describe CLO tranches that way at all, especially down the stack in double Bs and equity. I think there are trades that happen all over the place. And when I started investing in CLO equity, this is, I guess, 2011, 2012, you'd see a trade in equity and maybe your boss asks you why. Why did this trade at 80 instead of 70 or 90? And the implication of that is there's some really rational answer. And the reality is, after you've looked at it for a while, sometimes you're just not, or I'm not able to explain some trades. If you think about risk and return on a line, sometimes CLO securities just trade in a way that I couldn't necessarily explain. And what's funny about that is as we've become bigger at FlatRock, sometimes I'm asking a third party, hey, why did this private credit double B trade so wide versus the market or tight versus the market? And then the person's like flipping it back on me. They're like, well, I thought you would know. We're looking around and it's like, well, somebody got a good deal or didn't. So I like the fact that it's inefficient. I like the fact that if you're bigger, I think you have an advantage over peers. But my initial question was, what kind of advice would you give to a new associate? And I think for like a new employee, it's really amazing how much work they can do on their own in terms of coming up to speed. So one thing is there's probably 5+ investment banks that cover the CLO market, just like an equity analyst covers Meta or Google or Alphabet. And every 2 weeks, they're telling you, hey, this is what's important that's happening in your space. So for us, that's must read stuff. But the other thing is that if you have Intex or something comparable and you have access to our market's BWICs or auction processes, you can see where double Bs are trading any day, triple Bs, equity, which is a lot more challenging to figure out, but with different profiles. And you can see, okay, today, two pieces of equity traded. These are the prices. Well, you get the cover bid. So the second best, but you're in a range. And then from that, over a month or two, you can figure out equity of this profile, long and clean. Maybe that trades at like a 13% IRR. Equity that's beat up late in its life. People ask for a pretty high return to get excited about investing in that. And then, so for all of our CLO securities, we're getting third party marks daily. So the first step for a new associate is, hey, can you tie out these marks versus what's happening, the trades like we're seeing in the market? So obviously, if somebody new joins you, you're going to spend a lot of time with them, but the amount of work they can do on their own to figure out the asset class, to the extent it can be figured out, there's the ability to do that. I think the trick is to hire somebody who's a self-starter and is comfortable doing a lot of that work potentially on their own.
Two things that I picked up on this conversation. First thing that I would definitely piggyback on your comment about inefficiency of the market. And CLO market is a great example of that inefficiency. And thank God that it is inefficient. I couldn't imagine that that would be value if it was fully very efficient. And I keen to understand and appreciate and accept that that inefficiency is happening for a reason, because there are market participants with different objectives in their mind. Is somebody solving for X and another person is solving for Y. And I find that fascinating that one investor's opinion differing from another is the thing that really adds value to both of them. And it is one man's trash is another man's treasure. I don't mean it that way, but it is true that the same bond might have different value for different investors because of many reasons. So that's the first thing that I completely agree with you, that inefficiency exists. And the second thing, tying back to this new associate, that we would give him an advice. One thing is, like, I'm learning everything every day. I'm finding out new things and new ways of looking at the same thing that I've been looking for the last 20 years. And it's fascinating. Sometimes I kick myself, why didn't I think about it looking at this way? So what I would advise him or her is to go and connect with as many people as possible within the industry and try to understand, how do people look at the same animal that we're all looking at together. Some people see it as different than we do. They have different tools, different ways of analyzing it. And I like it that in our industry, people are pretty transparent about what they're doing and how they're doing it. And I find it that something that I would encourage anybody who's coming into this to put themselves into that network of people or investors or traders and try to figure out what other people are doing.
So last year was a pretty challenging year for CLO equity, and one of the reasons was that default activity was elevated. Do you think 2026, do you think conditions will be more favorable, or how do you see it?
The short answer is it depends. It depends on a few factors. First and foremost is the rates. If the headline rate continues to drop, it could be helpful that some of these would be defaulting issuers will find some relief on their debt coverage. So maybe the default rate is going to ease up. That's not the only factor that plays into it. There are some natural cycles that the credit market usually goes through. Sometimes those cycles are accelerated by exogenous events. GFC was one, COVID was another. There are some other more benign examples of that, but it could be a natural accumulation of would be defaults that might be breaking. Another cycle is the idiosyncratic defaults emerge at certain times in certain part of the cycle. The 2017 tightening wave that we had observed, and they continued for about 2 years, resulted in increased idiosyncratic defaults in 2019. I am cautious of that idiosyncratic environment coming back up again. We are seeing a few defaults pop up as more surprise, and that's basically a sign of idiosyncratic environment is not being so much constructive. I'm afraid that that will continue to increase. I think it is going to be a challenging 2026, yet it is not easy to identify a certain industry sector. It is most likely that lower rated, lower quality, lower debt coverage ratio issuers will have some difficulty. I think that elevated default rate is likely to stay in range bound. It's not going to go off the roof. It's not going to go down to zero. It is going to be oscillating between the current level plus minus a percent point.
So what you're saying is even as SOFR comes down as expected, so if you look at the SOFR forward curve, I think 3.1 is at least where the market thinks we're heading to. Even with the cuts implied in that, there's still going to be some idiosyncratic. So that's cats and dogs that, for whatever reason, are struggling in the current environment.
And we might be surprised that it could be postponed because there are a lot of factors that goes into it as well. And the general business environment is very important, whether we're going to be seeing real growth in the economy or we're going to see contraction in consumer spending. All of these are side factors that will contribute to it. All in all, I think that there is the uncertainty within the market that is higher today than it was maybe about a year ago. And I think that is going to hold a lot of larger investments within the business that might be very accretive for the markets. And therefore, a delay of those investments, you can call it as M&A activity, might make it a little bit more treacherous for credit than otherwise would be. How about you? What do you think?
I think I might be more optimistic than you. So the default rate, and I'm looking at JP Morgan data, but it peaked at 5.2% and then ended the year at 3.75. So heading in the right direction. And I think lower SOFR should be advantageous. The other thing is in all of our CLO profitability projections, we're baking in a loan loss reserve. I think most people use a 60 bip loss rate, which is 2% defaults and 70 recovery. And that's turned out to be quite optimistic, the 2 and 70 there. But we're already budgeting in for the 60 bip loss rate. And so you can be above the 60 bips and still have a decent year as long as it's not too far above. And of course, there's other factors in there as well. I also think private equity has raised a lot of money that's still waiting to be deployed, and they can either spend it or give it back. And my hope is that maybe some private equity firms will see value in some of these BSL loans or companies where they might have an idea for how to turn things around. And that might be beneficial to lenders as well.
I think there's one thing to add on top of what you just said is that the headline overall loan default rate can go either direction or can stay as it is. There is a huge dispersion among the investors, among the managers' performance in this asset class, given that loan market is quite large, give or take 1,500 issuers out there, and then any given manager has exposure to somewhere between 300 to 500 names. So everybody has a different corner that they have focused on, and the performance is expected to vary. And it did vary in the past quite a bit. And in my opinion, it is going to continue to vary. There might be some skew towards larger managers' performance on the recoveries or loss given default recoveries will be higher for larger managers, might be higher for larger managers because of the LME process. LME process might favor the larger participants a little bit more than the smaller ones.
So the LME is the liability management exercise. That's the out of court, less formal restructuring. Your point is the bigger players are able to navigate that process and end up with disproportionate recoveries, better recoveries than smaller guys. Is that changing though? I've seen like a few court cases where it seems like what the courts are saying is that all lenders should be treated equally. I guess you can be treated better to the extent that you're willing to cough up more capital yourself to support the business. But do you know where that sits?
I don't. On the other hand, I firmly believe that there's the spirit of the contract that people should stick to. And if you're invested into a tranche, and I can't imagine why investors would be in a position where the outcomes would be different. That's an opinion, obviously, that could be varied based on multiple factors. But I'm looking at a CLO tranche investor and I'm thinking, if there is a capital treatment that comes to the tranche that I invested, the contract that I signed when I invested in that tranche is that I'll be treated equally to the pari passu owners of the tranche owners. That would be my perspective. And I think the LME process is something that has evolved in the last few years, and it changed the dynamics on how the managers are managing their portfolios, how they are trading. I don't mean to suggest that the larger managers have advantage. Everybody has a different means of dealing with defaults. A smaller manager has a much better optionality on being able to trade out of the smaller position that they have earlier in the process, where the large investors do not have that luxury. So everybody is trying to play whatever the tools that they have, given that they're set up.
Well, one thing I've definitely seen is that the smaller managers or just managers who may be big overall but have a small position in a term loan, if things start to go south, if they're worried that there's going to be an LME or a more formal Chapter 11, they sell it quick because they realized, hey, I won't be on a steering committee. I won't have influence in this process. And they're like, yeah, I need to sell now and just de risk myself. Do you see loan activity, new LBO creation as picking up in the new year? Because if loans come with wider spreads, that's certainly something that can benefit us as CLO equity investors and really the entire CLO. And perhaps if that happens, there'll be less refinancing activity, which has been also a drain on CLO equity cash flows.
Early last year, I was hearing that the pipeline is very robust on the M&A activity, and there's going to be a loss of loan creation. The reality is that it didn't materialize. So it was a little bit disappointing for me to observe that projection not being material result. Made me think, okay, whatever I will think right now, I have to think again because this may not be the reality. I think there's a back up activity that has been pushed from last year to this year that makes me think that there is going to be a pickup on M&A activity, loan creation that will create a lot of supply to meet the demand on the CLO creation. I approach it a little bit cautiously. I'm hearing that it might be the case for this year. Some market participants are quite bullish on the idea that there is going to be a lot of M&A activity. My sense is that it is going to be delayed. It is not going to be right off the gate. We're already in January, end of January. I would anticipate that if that activity picks up, we're going to be seeing more towards the summer than earlier.
Would you also, though, expect a general declining spreads for CLO financing rates from AAA down to double B?
When you look at where we are in the spectrum post GFC, where the AAA spreads are, we have a little bit of room to go and hit the all-time tights. However, when you look at the calendar right now in 2026, a lot of 2024 vintage deals are going to be eligible for refinancing. And there is quite a bit of them, especially starting in Q2, where the volatility had started, as you would remember, 2024. That was a year where the AAA spreads were much higher than where we are right now. So whatever the tightening is going to be observing, it is going to be muted because it is going to be meeting with a lot of supply that is coming from refinancing deals, the deals that wants to either reset or refi. Therefore, I expect maybe the curve to be flatter between a refi and reset, between 3-year and 5-year. I think there's not going to be a very steep curve, but on the same sense, the demand for AAA paper will be meeting with a lot of supply. So the tightening is going to be muted.
So it's kind of like the fundamentals of the market would point towards CLO spreads tightening. However, our market is just going to print lots of deals and a supply demand dynamic just isn't. Maybe things tighten a little from here, but there's lots of CLOs to be issued, and that puts a constraint on how much things are going to tighten.
That would be my expectation in the market this year.
So, one other thing that weighed on CLO equity returns in 2025 was, my opinion is just that CLO equity trades cheap. So, stock market's at record highs, credit spreads are at or near record tights. But CLO equity, if you just run your projected cash flows through Intex, the market rate of return is very much elevated, in my opinion, versus the beginning of 2025. So, listen, everybody, as you know, they have different projected returns because they're running different models. But a 3% increase in potential returns as the result of lower CLO equity prices, that happening in a year where you also have elevated defaults and spread tightening on the assets is tough. Do you think CLO equity trades cheap?
Great question. Bringing back to the efficiency of the markets. So that is the equilibrium. I don't know whether it is cheap or not, but it is where people are willing to buy or sell. But I'll add a few things to your question because I think you highlighted a few very important things. What happened through the course of the year and how the valuation changes over time. There could be multiple things that contribute to it. Number one is that your yield expectation could increase, which is going to push down the price of the equity, and therefore particular performance on that particular year could be negatively impacted by the expected return increase. And that's what happened as well. So maybe that's what you're referring to as how the market is cheap. And I agree there that there has been an increase in expectation of the yield that you should get. That's number one. Number two is your now on the equity, how much principal valuation that you anticipated you are going to be getting from your equity investment. That had decreased on a typical CLO. The loan market is sold off as well, but that decrease again contributes to the performance of the CLO equity. And then the third factor is that your IO valuation, which is basically the excess spread between your assets and your liabilities, that had compressed. That had compressed as a result of this tightening loan market, and that's reduced your future cash flows, and therefore the performance on your equity got negatively impacted. So all of these three things happen at the same time with different magnitudes contribute to the performance of CLO equity in 2025. 2026, I think that some of these are saturated. Some of the factors that contributed to that performance, I think that wherever the equity is yielding right now, I don't think that there is any reason to anticipate that people will ask for more yield for the same risk. So that factor, I think, is saturated. The NAVs have some room to go. More defaults might contribute to it. I think the spread compression, I'd love to think that we're 3/4 down on that. So there's not the same pace that it is going to continue. So it is, I think, going to be more or less a neutral to a positive year for CLO equity. It might be a positive to a neutral year for 2026 relative to 2025.
How would you quantify a neutral year in CLO equity?
So if you look at a CLO equity right now, if you had bought it somewhere around NAV, you should look at your portfolio. What is trading above par on my loan portfolio and bring it down to par, meaning that you should anticipate that they are going to be refinancing. And then you look at what is the spread compression that you should anticipate on that part of your portfolio. Whatever that is, take it by 50 basis points. That's maybe a middle number that you should anticipate. And that should contract your IO component. And I'm not putting any refinancing optionality, assuming that you can run that separately and analyze whether that is something that you would like to put into your analysis or not. And if you put all of these things together, you could see that maybe your NAV performance could be a couple of points to 3 points down, excluding default situations. And your spread could be down for another 5 to 10 basis points. But on the other hand, if you can refinance your debt and you can maintain, I would say, mid-teens type of valuation on a base case scenario, I would say that I think you're going to be having mid-single digits to double digits in a positive scenario. In a scenario where there's the defaults that pick up and or the spread compression continues or accelerates, it could be down single digits to a flat. That might be the other end of the spectrum. So in my opinion, 2/3 of the market plus minus one standard deviation, the performance is expected to be within this envelope.
So in the base case you gave, that was, well, you're receiving in cash mid-teen return, but you're losing, call it 3% or so on your NAV. So maybe that takes you from 14% to 11, something like that. So that's where you'd see a positive outcome in that.
One thing that, and I'd like to hear your thoughts as well, I link the equity returns on any given year about what the double B does during that year. Because as a relative value investor, when you're looking at equity, which has so many variables that is going into it, and try to anticipate what will be the return on any given year, and you compare that, if I go just one tranche up and invest in double Bs, and if I put the same scenarios I'm putting into my equity analysis, and if that double B is giving you a double digit returns on most of the scenarios that you're putting, that's a very fair question for everybody to ask. Why am I investing into the equity instead of the double B? That was the case in 2021 and in later years until the double B spreads compressed to a meaningful level. The convexity is gone. And then CLO equity became very attractive because if you're looking for double digit returns, it doesn't exist in double Bs. Now you need to go down to the equity. And that's when we had seen increased activity in the secondary trading of that equity. Did you observe similar dynamics on your end?
Well, I see new issue BSL double Bs today at SOFR plus, is it 460 or something like that, which I think that's pretty tight. And how we've thought about it in equity, and we manage double Bs in equity, by the way. And how we think about the difference between the two is I think you need to target probably a 4% pickup in projected return to be enticed to go from a double B to an equity. So from going from a double B that has really a de minimis historical default rate to sitting in, the first loss position where every time a loan defaults, you take a little hit on your NAV. We see that as roughly 4%. Well, maybe I should say I see it as 4%. It's something that we frequently debate around the shop. And I think some people would maybe call it tighter than that, especially if you've got a long-term time horizon. The small changes in return compound greatly over time, as you know. I kind of like your simplified model for what's a return for 2026. You mentioned refis and resets. So whatever base case model Intex spits out, if you're not tinkering with your capital structure, there is upside in refis and resets. And in fact, I think one very positive development in the market for equity has been that the refi and reset market is open for almost everybody. You don't have to be an A performing top of the list deal or manager to do a refi reset. They're available to basically everybody. The worst deals, they're not going to get them, but even a sub performer gets a refi, I would think. And then my one reason I think to be optimistic that's also sitting outside of your model is that my opinion is that CLO market rates of return widen in 2025. And because the CLO equity is getting these pretty substantial equity cash flows, and also the projection is for the CLO to be liquidated at some point in the future. So you're not waiting indefinitely on your return. You're putting part of it in the bank each quarter. So when you have these high discount rates, as you move those cash flows from unrealized, highly discounted future to in the bank, as long as the cash flows come in close to what you're projecting, then you should see an improvement in the value of your CLO equity. So maybe a simple example would be you bought a fixed rate bond at 8%, and then a year later rates are 10. Well, that bond is sitting with unrealized appreciation on your balance sheet, and that's negative. But if the bond does actually pay you your principal, at the end, you earn the 8. So there's no unrealized depreciation at the end. Over time, the unrealized depreciation goes away as you get closer to maturity. Well, part of that is there was an opportunity cost there. If you would have waited to invest, you could have made 10. But the reality is, in that example, you need cash flows and equity to still approximate what you were planning on. But a reversion of to more normalized CLO equity returns, I think would move up the entire market. And as SOFR comes down, my hope is that CLO equity cash flows, which are high, are all the more attractive to people. If your CLO equity pays you a 15% yield and market rates are 12, that doesn't make any sense. If market rates are 3, which maybe that's where we're going on SOFR, I think that is interesting. So I'd also say I think the challenge for predicting the market, and I'm getting asked this all the time by our investors, I think it's a good question, but fortunately, not a lot of companies default. So that makes it very hard to pull out your crystal ball and say, hey, our default's going to be 2% or 2.5. How could somebody with a straight face put any conviction around that? The realities are going to be elevated. I liked how you put it in kind of like a confidence bound, but I think fortunately things are heading in the right direction. That's my view. And then also what I've seen in the past is once you get through these periods of higher defaults, the remaining loans that you're left with are loans that have been tested and survived. And so if you look at a default rate chart, you hit a peak, and then the next thing that happens a year and a half later is that you're below your average default rate. So the default rate doesn't tend to stay high indefinitely, thankfully. It moves down when the weak exit the pool through restructuring, and hopefully the stronger portfolio is what you're left with.
Default cycles have positive impact on the loan market's long-term viability in a sense that following the default cycles, you usually see the spreads widening. And that spread widening on the issuance gives an appetite to the investors to come back into the market and finance this into a new level where eventually the market is going to find where that equilibrium is. But I find them that are healthy, especially when they happen in a systemic bound, meaning that the elevated default environment makes it difficult for an issuer come in here and issue a loan at 275. They have to do it for 25. They attract a lot of investors. They attract a lot of attention. And then they have to be on their tippy toes to be able to service that for 75 or 450, whatever the higher coupon that they have agreed on. And it pushes the efficiency on their end of their business, whatever the business that they're running. And all of those are healthy contributors to the overall health of the economy. And as we go through these cycles, the CLO investors look at it like, what is the right time for us to participate in an equity as opposed to double Bs? I find it fascinating that there is value on all parts of the capital structure, depending on what you're trying to accomplish. Sometimes there is more skew towards one to the other, but it is always in cycles. There's no such thing as that, oh, there's no value going forward anymore in X part of the capital structure. Well, that is not sustainable if there's no value on that part of the capital structure. The issuance will stop. When the issuance stops, then there's going to be more supply of loans to the market. And that is just going to go back and rebalance itself to an attractive level again. And market self-correction mechanism is just going to make sure that everything is moving in an efficient market paradigm, but in the long term. That's the key word. I think this CLO investment should be viewed as something that you can measure in a longer time period rather than a year or maybe two. It's important to be patient when you're investing in CLO, particularly in the lower part of the capital structure.
Serhan, you've been in the CLO market for a long time. What's the dumbest thing you've ever seen somebody in the market do? Does anything come to mind?
Quite a bit it comes. I don't know. I don't know.
Let me tell you mine.
Yes, I'm very much interested.
So in 2011, I transitioned from working for CLO managers. So I was at Canaris at the time, picking the loans that go into CLOs, like your team does there, to investing in CLO equity. And at Canaris, we did have pockets where we were buying CLO double Bs. So that gave me some insights into what investing in CLO equity would be like. But once you find yourself in a new seat, I think it's smart to just kind of ask around and be like, hey, what's the dumbest thing somebody investing in CLO equity could do? You'd maybe ask a few banks or a trader to find out. And I heard that there was one CLO investor who, when bidding on equity, just looked at the NAV. Maybe they took a trustee report or pulled it up in Bloomberg. And usually in equity, NAV is the lower bound for what something's worth. It can be worth a little bit less, but NAV is the liquidation price. So that kind of sets a floor. And they bid NAV and they won. Well, it turns out that it was a CLO 1.0 and the incentive fee was in the money. So the NAV, I don't know what it was, 50 cents or whatever, that was the NAV. But the manager, they owned 20% of the NAV, again, because the deal had performed quite well. So they way overpaid for that equity position. So that's, I guess, on somebody's blooper reel. But as long as you run your cash flows through Intex or something comparable, you're never going to have that issue. But I think that's the biggest miss I think I've come across.
It is important to get yourself educated and also trained before you jump into CLO equity trading or investing. If that's the level that you'd like to operate, I would suggest that any investor start with playing with mezzanine investment and do triple Bs and get yourself familiar with the managers, get yourself familiar with the structure, and then venture into double Bs. And then if you feel like you're building that expertise and knowledge, then you can go to single Bs. Single Bs are not as common in US market as it is in European market. But there are some debt single Bs that exist. But then the next step is the equity. I think investing in primary equity is quite different than investing in secondary equity. And that's something that I think whoever is venturing into CLO equity investment has to spend a lot of time with other market participants and the managers that they are willing to invest in. Staying close to the managers is very important. I think that when you're investing in a CLO equity of a manager, you're basically investing into their behavior, not what that portfolio is today. And you can do all kinds of analysis, but you need to really understand how they're going to be behaving. The example that you gave is not related to this. It's obviously a very fundamental level, entry level situation. But that would be the advice that I would give for anybody who wants to participate in the lower end of that capital structure, or just partner up or invest with a CLO equity investor like yourself and try to co-invest. That would be another way to get familiar with the market.
That's great. Serhan, my closing question is always describe a CLO in 30 seconds.
I love this. Somebody told me finance is not really complex. It's very simple. The complex part is how you can simplify it. So I thought about this question just recently, and my answer is as follows. CLO is an agreement on multiple investors on how they would like to divvy up the returns and the risk among themselves. It's nothing more complicated than that. Three investors come into a room. One of them tells, you know what? I don't like a lot of risk. I don't want to take a lot of losses. And I'm willing to give up some of my return on that portfolio in exchange for protection. Another one says, look, I would like to take higher return on my investment, and I'm willing to take more risk and protect you guys from the losses. And the mezzanine is anywhere in between. So this is my answer.
That's great. Well, Serhan, thanks so much for coming on the podcast.
Shiloh, thank you very much for having me on this podcast. This was very, very interesting and very enjoyable. Thank you very much.
All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any Flatrock Global Fund. Definition section. Secured Overnight Financing Rate, SOFR, is a broad measure of the cost of borrowing cash overnight, collateralized by Treasury securities. The global financial crisis. GFC was a period of extreme stress in the global financial markets and banking systems between mid-2007 and early 2009. Credit ratings are opinions about credit risk for long-term issues or instruments. The ratings lie in a spectrum ranging from the highest credit quality on one end to default or junk on the other. A AAA is the highest credit quality, a C or a D, depending on the agency. The rating is the lowest or junk quality. Leveraged loans are corporate loans to companies that are not rated investment grade. Broadly syndicated loans are underwritten by banks, rated by nationally recognized statistical ratings organizations, and often traded among market participants. Middle market loans are usually underwritten by several lenders, with the intention of holding the instrument through its maturity. Spread is the percentage difference in current yields of various classes of fixed income securities versus treasury bonds or another benchmark bond measure. A reset is a refinancing and extension of a CLO investment period. EBITDA is earnings before interest, taxes, depreciation, and amortization. An add-back would attempt to adjust EBITDA for non-recurring items. LIBOR, the London Interbank Offer Rate, was replaced by SOFR on June 30th, 2024. Delever means reducing the amount of debt financing. High-yield bonds are corporate borrowings rated below investment grade that are usually fixed rate and unsecured. Default refers to missing a contractual interest or principal payment. Debt has contractual interest, principal and interest payments, whereas equity represents ownership in a company. Senior secured corporate loans are borrowings from a company that are backed by collateral. Junior debt ranks behind senior secured debt in its payment priority. Collateral pool refers to the sum of collateral pledged to a lender to support its repayment. A non-call period refers to the time in which a debt instrument cannot be optionally repaid. A floating rate investment has an interest rate that varies with the underlying floating rate index. RMBS are residential mortgage-backed securities. Loan to value is a ratio that compares the loan amount to the enterprise value of a company. GLG is a firm that sets up calls between investors and industry experts. Payment. In kind, or PIK, refers to a type of loan or financial instrument where interest or dividends are paid in a form other than cash, such as additional debt or equity, rather than in cash. A covenant refers to a legally binding promise, or lender protection, written into a loan agreement. Net asset value, NAV, the value of a fund's assets minus its liabilities, typically used to determine the per-share value of an interval fund or investment vehicle. Dividend recapitalization, dividend recap, a refinancing strategy where a company borrows to pay a dividend to its shareholders, often used by private equity sponsors. Continuation vehicle, a fund structure that allows investors to roll their interest in an existing portfolio company into a new vehicle, while offering liquidity to those who want to exit. Equity cure, a provision that allows private equity sponsors to inject equity into a company to fix a financial covenant breach. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. General disclaimer section: FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on U.S. markets and U.S. monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com.